So when you look at actually what really wealthy people do, most of them are not just, oh, I've just saved my whole life and I did this and it's been really, unflashy. A lot of them took some risk, they took some calculated risks and they learned and they continue to make adjustments. They found unique opportunities and there are opportunities out there. And as things are changing, particularly with COVID and supply chain and in business and in the world, things are changing so quickly. It creates incredible opportunities for investors to take advantage of some of these changes. Now, there's also opportunities to lose a lot of money. So you don't put 100% of your money in one thing. Maybe you spread it out a little bit or you learn. I mean, but even the great Warren Buffett, he says you don't need a million investments. You need, maybe 6 investments that you really believe in. You watch them closely and, put your, because then you can actually keep an eye on them. So there's some of the different things like, major diversification or just simply buy financial assets, just as stocks as bonds. These are safe. A lot of these things I just don't really agree with. I think that they're completely wrong. And I think when you start buying real assets or you start actually interviewing people that are wealthy, they almost all got there through some what we call alternative strategy. So then it becomes like, well, is it really alternative or is this just really how people become wealthy? And yet we're all convinced through media and finance that you should be doing traditional stuff. So I find it's kind of counterintuitive to the way we're taught about finances.
Hello and welcome to the Disrupt the Everyday podcast. We're here to help you navigate life while disrupting the status quo. Our discussions cover a number of topics relevant to everyday life. We discuss everything from relationships to entrepreneurship. We also engage in some difficult but important conversations. And now, here are your hosts, Brian and Tanya Hamilton.
Welcome to another episode of the Disrupt the Everyday podcast. Today we'll be talking all things financial with a focus on multifamily investing. And we'll be joined by Bronson Hill. Bronson, thanks for joining us today.
Hey, Brian, Tanya, really excited to be with you guys today. Love talking about finance and real estate and love disrupting the everyday. Let's do it.
Let's do it.
Yeah.
All right. Well, let's start by learning about you, Bronson. Who is Bronson Hill?
So it all began with a young boy and a dream. No, I'm kidding. It didn't. I won't go back that far. What I do is I help people to achieve passive income through real estate investing. So they don't have to actually manage properties, but they can get all the benefits, including tax benefits, great returns, downside protection, and they can actually invest passively. So they typically will invest in a deal and vet our team, vet a property itself, and then just receive the mailbox money. So I actually have the Mailbox Money podcast or the Mailbox Money Show, which is on YouTube and iTunes and other places you get podcasts. But that's what I do. And my background is medical sales. I did that for 10 years, and I reached a place where I wanted to have more freedom over my time. And so I started investing in multifamily real estate, started to bring other investors to deals. And now we've got $200 million in multifamily assets. Been doing it about 4 years. I was able to leave my wonderful corporate job, but I wanted control of my time. So I was able to leave that about a year ago. And now I'm able to really pursue this full time and really help people with their financial goals. So I love it.
Wow. So I got to ask, when you went to your wife to say, you know what, I'm done with corporate and all that kind of stuff and that steady, biweekly paycheck and salary and all that. How did that all go down?
Yeah, well, actually, it went pretty well. I actually am not married, so my wife was very responsive. She was very supportive. But I do have a daughter, so my daughter is 9.5, and I do share time with her mom. And so I basically really had to think through what are my financial obligations. And I realized for me, and just being vulnerable with this, I live pretty simply. I live in Los Angeles, but I live pretty simply. So I realized there's different forms of financial freedom, right? One is actually where you cover your how much money you're making. And I was making over $200,000 per year. So I was making a lot of money. It'd be hard to cover that number. But I realized if I covered my expenses, which were only about $50,000 to $60,000 a year, then I could actually potentially leave. And I got to where I was covering my living expenses with passive or just investment income, and then anything else would be kind of a bonus on top of that. So again, I think when it comes down to it, we call that number your rat race number, right? If you can cover your living expenses, with passive or investment income, then you're free. You can choose if you want to go to work. You can choose how you want to work, what it looks like. And most people don't have that choice. And I think there's a reason why 65% of people, at least in the US, they don't like their jobs. They don't like their managers. And so if you're just having the ability to be able to leave your job is I think that's really where financial freedom starts.
Absolutely, and I think too, there's a lot of value, and we've had this conversation, at least this kind of component of it with other folks. But there is some value in having employment while you're building something else. Again, just because you do have that safety net, you do have the ability, you do have a little bit of freedom to make some more mistakes and take a little bit more risk as well. And also, I'm sure there's things that you learned from your corporate experience that you've been able to translate to your business.
Yeah, you bring a couple good points there. Some people wonder, well, when do I actually leave my job? Some people they wait till they're a month short of retirement and they say, great, I'm leaving my job with passive income, and then they retire, or, quote unquote retire. And then other people, they hear about real estate and they quit their job and they take out a loan and go start doing education and real estate. And then there's no real, I think obviously that second plan is a little more risky, or a lot more risky than otherwise. It is great if you have a job that has some flexibility, or you have additional time that you can commit to it if you're trying to be more active in real estate. Because there's two ways to really do real estate. One is more active, where maybe you're buying single family houses, or you're flipping, or you're doing other things yourself. And that's a more active way where you're leveraging your time for money. And hopefully it's more, it's more money than you'd make in your normal job. And so we try to get out of the time for money trade, which is where passive investing becomes so magical for people that have money, that make a lot of money in their jobs or have resources. Then you can invest passively. But either is really trying to work for the same goal, right? Trying to replace your income and to try to work yourself out of a job, or at least have the option to be able to do it. So I think there are definitely different options for different people there.
Perfect. Now, in terms of investing, again, it can be daunting when you look at real estate investing. So, the multifamily approach. Can we talk about that?
Yeah. So I discovered multifamily. This was 4 or 5 years ago. Somebody used the word, at least in the U.S., we call it multifamily syndication. And multifamily just means apartment buildings, where lots of people live, and typically it could be 2 units up to 500 units. We found that larger buildings are actually a little easier to do, which is very counterintuitive. Like if you have a 10-unit apartment complex versus a 100-unit apartment complex, it's actually easier to own and operate a 100-unit apartment complex because you have more full-time dedicated staff. Typically, you have people that are on site at the property, including maintenance people and leasing agents and other things. So it does get more efficient. But with multifamily, there's a lot of economies of scale that you get. So, for example, I have friends that own 60 houses, and they have to, when they have a repair, they've got to send a repair guy at $30 to $50 an hour to go to the house, look at the problem, diagnose it, go to Home Depot or go to a hardware store, pick up the product, bring it back, the repair item, repair it, and it can be half a day just to do that. And then you think of the repeat on the other 60 or 59 houses. If you have a 60-unit or 100-unit apartment complexes, you've got it all in one place. And so it becomes much more efficient. So typically the maintenance person, you have 1 or 2 maintenance people that work there full time. And so you get a cheaper rate for them. And it's typically all the same types of appliances. It's all the same colors of paint typically. And so it's much, much more efficient. You have one roof, you have one, connected set of plumbing, and it's all in one location. So it's much, much more efficient. And again, for people, when they learn about multifamily investing, they don't realize that it can be very different than owning a rental house. Owning a rental house, even with a manager, it can be a very active process where they're asking you, hey, the toilet, the toilet, backed up last night. What do we do? Or what do you want to do in this situation? Or your tenant's not paying or whatever. Well, you get one non-paying tenant out of 100. It doesn't really affect you very much, right? You kind of count on that. Some of that's going to happen, but it becomes much more of a financial asset where you have a lot more predictability in how it runs. And then also you have much more efficiency in how it runs as well.
Now, I guess, looking at many people for when it comes to the multifamily buildings where, if you have 100 units per se, right? Not everybody has that money to put down on a down payment. So I know with what you do, there's a lot of, going in and collaborating, I guess would be the word, becoming business partners there. So can you share a little bit how people can look outside of the box when it comes to that kind of stuff?
Yeah, so a couple ways, how this syndication, type of situation works. I think in Canada they call it real estate private equity, but it basically is where you have 2 types of people involved in the group. You have, more active investors, which we call general partners, that are actually operating the deal. So that's like myself and my team. We actually operate the deal. We find the deal, we get it under contract, we do the diligence, we walk the units, we get ready, we close on the property, we raise the money, we manage the asset, and we also work with investors afterwards. So that's what our team does as general partners. And there's what's called a limited partner. It just means your function is limited. So
Right.
most of the people, that put money in, our team also puts money in as active and passive investors. But for the limited partners, it's basically people put in 75 or 100,000 and they invest passively in a multifamily or other type of real estate deal, and they receive cash flow along the way. And then typically there's appreciation, and you're usually working on a project, you're trying to renovate units, you're trying to see increases in the rent over time. So those are kind of ways people get involved either actively or passively in multifamily. Another way people do it, again, is they try to learn. And this is what I did, is I didn't really have, if you either have time or you have money, right? If you have money, you can invest passively as a limited partner. If you have time, you can leverage your time and you can become a general partner. I didn't really have either. So I just kind of hustled. I just worked outside of my regular job, and I found a way to, work with investors and raise funds. So some people, we actually coached people, the group called Kingdom REI, where actually it's a faith-based kind of Christian group that helps coach people to raise money or to find deals. So there's just different ways to get involved. And that's what I love about it, is that it's really something you can enter in, kind of what you have that you can be able to offer as far as financially, or what you can offer as far as value to help educate others how to do this.
Okay.
Great. So let's talk a little bit more about how you got started when you didn't really have the, as you put it, the money or the time. What were some of the things that you were doing to first of all, just to find the people that you would collaborate with and really, get them to believe in you as someone who they'd want to collaborate with?
Yeah, so I think in the beginning, well, no matter what you're doing, if you want to learn something that, you have to find people that are successful in that. And you have to see, what are the things that they've done. I always feel like people become like teachers or models just by watching what they do. So you can watch what people do online. You can see their YouTube stuff. You can, you can go to meetings. There's meetups locally. There's national conferences. And so there's two things we really talk about, especially in real estate, but I think it's applicable to other things. It's the idea of networking and education. So the networking piece is, if I locally go, I live in Los Angeles, I know you guys are in the Toronto area, there's meetups in these markets to talk about real estate, that people are interested to talk about real estate, or sometimes there's even ones about multifamily real estate. I run a multifamily real estate meetup in Southern California. We usually have 40, 50, 60 people there that show up, which is awesome. So we have a great time. So you meet very interesting people that are maybe a couple steps ahead of you, and then you can ask them questions. And most people are very willing to help share their experience. And maybe they have a concern. So like with a meetup, I actually started a meetup in Southern California when I didn't really have any multifamily, but I started a multifamily meetup, which sounds ironic, right? But when you start a meetup like that, I didn't, wasn't being anything fake. I just said, hey, I want to be a leader in this space. I want to really learn. And so I started a meetup with 60 people at the first meeting. And so there's a strategy to kind of get people in the room. And then we're there, and I met a guy who's like, hey, I'd invest in one of your deals. And I was thinking like, wow, like, I don't even have a deal. But then I had met a guy at that same meeting who had a deal, who was raising money for the deal. And I became a partner with him. And so I connected this guy who was looking for a deal with this guy who had a deal. So that's kind of how it can work. If you find yourself in a place where you can really create value for others. And I look at it like the alternatives really is, a lot of people are putting their money in retirement accounts. They're putting it in the stock market, which I see as incredibly volatile. It has a lot of risk involved. And I see these, we call it real estate or real assets, because they are actually physical and tangible. And I think that Wall Street and a lot of these big financial firms have really convinced us that these are unsafe type of assets. So being in the part of meeting other people to educate them is great, to get educated yourself. And so that second piece of the networking education is education, right? Going to national conferences, reading every book I could, talking to other people. But there's this great quote, and it's by a guy named Charlie Tremendous Jones. And he said, you'll be the same 5 years from now. You'll be the same person you are 5 years from now, or you're the same person today, 5 years from now, except for the books you read and the people that you meet. So it's just, if you want to change your life, you got to start reading books, and you got to start meeting people. You got to start educating yourself, and you got to start really learning and just expanding your network.
Excellent stuff. Now, the other thing I kind of wanted to focus on there is the whole idea of inflation protection. So I guess kind of the thing that's been coming up in some of the circles that I'm in, and maybe this says more about the circles I'm in. We talk a lot about inflation. So let's kind of talk about the state of inflation and how real estate helps protect ourselves against the rising inflation.
Yeah, I think it's something everybody's talking about. I think, everybody in general is going to the store and seeing food costs more, gas costs more, everything is costing more. The stuff that you're buying, just, different products. And I was looking for a new kind of like a deep freezer And everything's like twice as expensive, right? Just everything is more and more expensive. And so, why has this happened? One of the reasons this has happened is, at least in the U.S. and a lot of, I'm sure in Canada as well, a lot of countries of the world, they've created so much new currency. And that's one of the reasons why we're having inflation. There's also some supply chain stuff with COVID and other things. But primarily, in the U.S., we had a 2-year period between February of 2020 and February of 2022 where the money supply, so the money physically that you hold in your hand or money in bank accounts in the U.S. increased by 40.9%. So over those 2 years, it increased. There's almost 41% new currency, which we've never really had a time like this, where just so much new currency has been created. And it's guised in the name of like Inflation Reduction Act and all these other things where it's like, if you print more money, it actually does create more inflation. But there's a lot of confusion around that. But there are actually ways that you can actually make inflation your friend. So it doesn't hurt you every time you go to the pump or you have other, and this is really what happens to a lot of lower class and the middle class is that they don't own assets. So it starts to penalize. I actually wrote this ebook on my website, or I have it available on my website. It's 50 color pages. It's how to use inflation to your advantage. And basically it's a free download. You can go download it, but it gives some strategies. I'll give kind of an overview, but with real estate, we're able to use debt that people are saying, oh, rates are going higher. Well, we're still getting 5% or 6% or whatever the rates are. Inflation, at least in the US, is 9.1% officially, but unofficially, we think it's really like 15 to 18%. If you actually look at the cost, including energy and rents and other things, it's actually going substantially up. So we're able to borrow at this really cheap, low rate, and then we have to pay off in future dollars that are worth less due to inflation, as well as we know these assets over the long term are going to be worth more. So we're basically getting paid to borrow. So for example, we have a apartment building that we bought. This was in March of 2021. We expected to hold it for 6 years. It was $27 million. It was a large apartment, 288 units. We planned to hold it 6 years. We got an offer for 37 million. So bought it for 27 million, 37 million, only 10 months after we bought it. So again, when you get a pop like that, where the property goes up in value by, let's say a property goes up by 20%, but you only put 20 or 25, 30% down. Well, you've sometimes almost doubled your money in that case, which is incredible. Right. So you're using debt, you're able to take advantage of inflation. So that's one strategy. There's some other strategies given here as well, but it really comes down to using wise debt and buying assets that will pay you to hold them and will cash flow.
Yeah, no, makes perfect sense. Now it's funny because it makes me think back to, I remember one day, like one of my first jobs was on a construction site, and there was a conversation that was being had about a guy who had actually essentially paid his mortgage, and he didn't really borrow against his home or anything like that. And this was a few years ago. This was like at least 20 years ago. No, actually, it's probably exactly 20 years ago. Don't want to date myself too much. But anyways, this guy, his final mortgage payment was $92. So, and he had a nice house, but just, again, the 25-year mortgage, inflation over time, it's unheard of to have a $92 mortgage.
Yeah. If he had it for a long time, and it's an interesting question. A lot of people, if you bought a house a couple of years ago, at least in the US, again, I can't speak for Canada, but there are some people that I know that have something like a 2.25 or 2.5% 30-year fixed interest rate, right? So what happens over time is that people say, oh, I should pay my house off early. And I say, no, you really shouldn't pay your house off early. I mean, everybody's situation is different, of course, but if you're paying your house off at 2.5%, basically you're getting like a 2.5% return on your money. And so versus if you just pay minimum payments, you're actually really using inflation. So the asset itself is not necessarily the house over time. It becomes the loan, right? The loan is at such a low rate, and we know things are going to appreciate over time. But you're right. There's people that have, they were paying a long time ago. They have these very low payments, and now, but I think the rates that we've seen as far as interest rates, I don't know that we'll see those rates again for a long time. Or if ever again. I mean, it's just been a really unique time. So we'll see how things go. But it is an interesting time in the real estate market, particularly single family.
Yeah. And also looking at, I guess, the different areas. So like for us, we're in Ontario, but other places in Canada, the housing costs are a lot less. So for us, we looked out of province for our rental properties, and we had success there. Now, I'm going to guess that you guys look not just in where you are, but all over when it comes to investing, right?
Yeah. So we're a little different than a lot of other groups. A lot of groups like doing stuff kind of in their backyard. And I've heard this saying, it's basically invest where you live where you want to, and invest where the numbers make sense. And so, I have the ability. I live in California, and we don't own anything in California. We have 2,000 units, multifamily units. all in Jacksonville, Florida, Atlanta, Georgia, and we have some in Alabama. So we've basically got most of the Southeast. And what I like about that is that we're seeing these areas are having phenomenal population growth. And when you have a lot of population growing in an area, it makes it very attractive. So the kind of the factors we look for as far as picking a market, because a lot of people are, well, where should I invest or what should I do? I look for areas where you see population growth, job growth, and income growth. If you go where the population's going, where the jobs are going, Jacksonville, Florida, for example, there's a lot of retirees that are living in Chicago or in New York or maybe even Canada. They want to live in Florida, and so they move down. You can still buy a decent house for $300,000 in Jacksonville, Florida, in a good area. And so all these people that are moving there, so many people moving, there's not enough housing. There's people that they need to, do the, restaurants and food service and clean the house and all kinds of supportive, medical care and all these things. And so we're seeing those things grow. And then we don't have things like rent control. We don't have other sorts of, you can actually, do the renovations and then eventually see, increases in rent for the property. So it's amazing to see areas like this where we just see all of the positive things that we like. And there are other areas as well, but those are some things that we look for when we look at a market.
Mm-hmm.
Awesome. Now, one of the other, and this is just my own curiosity because I know this was a hot spot in the U.S. at one point, but Texas and kind of that like Dallas Fort Worth area, is that an area that you ever looked at? And I know there's been a huge influx of people there, so maybe the numbers don't make sense now. But was that ever an area that you considered?
Yeah. We owned some stuff for a while. We sold some property in Texas. We had some stuff in Amarillo. Dallas is continuing to grow a lot. But Dallas has become a very major city, and we think in terms of something called a cap rate, which basically is just how you determine valuation. So if you owned a property, like let's say you had a house that cost $100,000, and after all expenses were paid, let's say you owned it cash, there's no loan, but all the expenses were paid in general, and you were returning about $5,000 per year. That would be a cap rate of 5, right? So it's just basically what percentage of the cash, if it were purchased cash, would you be able to get as far as your returns? In Dallas, we have some cap rates where it's come down to 3s or 4s, which are similar to what we're finding in Los Angeles. So we're not finding really quite the deals there. But again, every area is different. There's a time to invest and there is a time to buy. And I think we kind of look more at, right now we see Jacksonville, Florida as being the most desirable place that we love, but it won't always be there. So we're continuing to look at new markets, and it's hard to see exactly where things are going to happen. But I do think people are going to continue to move to Texas. I love the Dallas area. I think it's great. I just think the valuations right now, it'll be interesting to see if they continue to stay very high or if they dip, they come down a little bit. So we'll see.
Yeah, and if their football team can ever get things figured out, Jacksonville will even do that.
That's the question. Yeah, I've got some friends. I got some friends that are diehard Cowboy fans, and they're still, since Troy Aikman, they're still kind of holding on there, right? It's been a long time.
well, Jacksonville's got Trevor Lawrence now, so we'll see what happens with that team, because they've been having it rough for a while. Yeah. I'm a Panthers fan, so I can't really say too much. But
okay, so you're a rival fan. That's awesome.
I want to get your thoughts as well on saving money, because obviously you need to have assets, but people have different kind of views on this, whether it's worthwhile to invest more or save more. What are your thoughts, Bronson?
Yeah, so it's interesting. I tell this story. I've told the story of my grandmother when I was 8 years old, took me to the local bank in Seattle, Washington, where I grew up, and we opened a savings account at the bank, and I put my $2 a week allowance, and there we go there weekly, and she's teaching me how to save, and and at the time I really appreciated it. Taught me how to save money, and I think saving money can be good. A lot of the Dave Ramsey or the big financial guru type of, getting out of debt, it can be very, very good. But however, I do think some of the rules have changed. I think there's a 101 kind of evaluation of like, you really shouldn't have, in general, this is very generally, you really shouldn't have credit card debt. Credit card debt, at least in the US, it can be 15 to 25%. I mean, just by you paying that off, you're basically giving yourself a 15 to 25% return per year, which is a pretty good return. And it's more of like, so just getting out of that is good. Now, if you're saving money though, if I have 100K in the bank in Canada or in the US, like I'm losing between $15,000 and $18,000 a year just by sitting there. And this is something a lot of people don't understand, is that if I just hold cash, because again, the confused mind will say, I don't know what to do, and we'll just wait and just won't do anything. But 100K in the bank, you can literally lose over the next 2 years as much as 40% of your purchasing power, which is really hard to believe that if inflation is 15, 18% and you annualize that and you cumulative amount, that's close to 35, 40% of just loss of your purchasing power. So people that are waiting for a crash or they're waiting for things, I just don't know that things are going to come down 35 to 40% because of all this new money that's been created. So what I try to do is really try to hold less cash. I do things like real estate. I get into different properties. I get into other cash flowing deals outside of what we do. I do have some things, even I talk about in my ebook, where I'm in physical metals. There's a big case for buying physical gold or silver. I don't like ETFs as much for something called counterparty risk, which means if there's anything in the financial system or any company that fails, you really don't have any product. So but there are ways you can invest in physical assets, even something like Bitcoin or other sorts of cryptocurrency, which has kind of gotten hammered lately. But just having things outside of the dollar or outside of the Canadian dollar can be very, very valuable. So that's kind of how I approach it.
Okay. So I have a question. I mean, there's risk to all this, and we've learned as we've gone along our way to, rental properties. So I would love to hear, do you have any stories that you look back and think, oh man, I'm so glad we got ourselves out of that?
Oh man. Yeah. I think anybody who's been a landlord, especially if you're on the active side, these stories are so memorable. I remember I had my first rental house I bought was in Billings, Montana. So it was up kind of, near the Canadian border, not too far, within a few hours, but 4 or 5 hours. But I bought this house. I was living there. I ended up keeping it and then renting it out as I left. And there was just some tenants that got in there. I had a management company. And these tenants were just from the day one, they were challenging. They kind of all culminated with, I got this Facebook Messenger invite from some neighbor I didn't know who said, hey, these guys had a wild party last night. It was crazy. And the cops were called. I didn't really know how bad it was. But I guess in the middle of the party, was not only loud music and people everywhere and milling around. There was actually a brick that came through the large front window in the front. And this is a pretty big window, and so it came through the front window. And so I remember when that happened. I ended up, firing the property manager, getting a new one, and that cost some money to kind of repair all that. But just some of those things that happen, they stick in your mind, right? And so when people think of real estate, they can think of that. But there are ways, obviously, with multifamily, with other things that you're trying to you're trying to mitigate all the risks, and there's ways you do that through background checks and credit checks and just things that you try to follow. But sometimes stuff just happens, and we've had a couple buildings where we work with very large properties that have 300 units, and there's a fire in the building, and the fire burns down one of the buildings. And some of these buildings, some of these properties have 20 buildings in them or something, and so which actually it's interesting if a building burns down, and we've had nobody get hurt, thankfully, or nobody die from that. But we've had basically they go in and the insurance will go build a completely brand new building with updated specs and everything. And they'll basically pay you because of insurance. They'll pay you for the time that you did not get rent from it. So instead of it being rented at 90%, it basically your income usually goes up. So it's kind of ironic how some of the stuff works in some of these larger properties. But yeah, I mean, you hear all kinds of horror stories of things happening, and but in general, with good systems, with good management, you can avoid about 95% of those problems. And then sometimes you just realize stuff happens, and when you're managing hundreds of tenants, stuff will happen, and it's all part of the deal.
Exactly.
Now, another thing, Bronson, you've spoken with over 1,000 high net worth investors. What are some of the things that you've learned just from speaking with these individuals? Is there any kind of common threads that you see in just their approach to things or their thought process?
Yeah. So, I was able to interview, it's actually close to 1,300 millionaires now, and the average net worth is about 2 million. Some were worth, 20, 30 million or more. And one thing I've learned is that there's a few things that are really important to people that are wealthy. One is really their time. They really value their time. Time becomes, I think Benjamin Franklin said, time is money. And the more money you have, the more you realize how much your time is worth. You can make more money, but you can't make more time. And people that aren't as wealthy don't realize, like, wow, if I really look at how much my time is worth or how much I make in my job, I might actually pay for more types of services or more things to be able to get done or take care of certain things. So that's very important. Also, a lot of these people were very interested in their own financial education. So even though they were very valuable, they were really interested in listening to shows like yours about disrupting the everyday. They were really interested in financial education and reading books and going to conferences just for the sake of learning. Because a lot of people that are wealthy, they're want to learn how to, like all these things we're talking about, how to hedge inflation, how to, if you don't have wealth, you're basically trying to find the hope that maybe you can grow your wealth. I was able to 20x my net worth over a 4-year period, right? It's possible. So people that, are not wealthy, I share those stories. And then people that are wealthy, I usually talk, it's more of, well, how do you not lose your wealth, right? If you're worth $20 million, you just don't want to lose your wealth due to inflation. You don't want to lose it due to a lawsuit. You don't want to lose it. So it's interesting. A lot of people are more concerned about how do I maintain and not lose my wealth than it is somebody who's less wealthy and then trying to become wealthy. So, but it's interesting to watch. A lot of wealthy people, they have really unique habits where they some of them will travel, but it really comes down to valuing their time, educating themselves, and continuing to grow. I mean, most people that are wealthy, and actually this is something that was really curious. There's a study by Fidelity Investments, the big firm, that said that 89% of millionaires are self-made, which is kind of very different than the way the media presents it, right? That people are born with a silver spoon in their mouth, that 89% did not inherit their wealth. And so that shows really through your own education and through learning and through getting out there and taking action, anybody can really become wealthy. And it's almost anybody can become wealthy.
The other thing I want to circle back to is, we kind of discussed the Dave Ramsey. He has the baby steps, and it's a really good foundation. Like, there's some things that if you're not doing, like having an emergency fund, for example, you should definitely have that in place. As you mentioned, some of the rules have changed, and I've heard other people say similar things, like they feel like some of those steps are outdated. And could we talk about some of the things that you think are important for someone who's, I guess, new to taking on taking a more serious approach to finances?
Yeah, I think so. I talk about, and I love Dave Ramsey, and I love a lot of the financial gurus. I think they're great. Some people think, oh, you don't like Dave Ramsey, you don't like these people. And, I do. I think for most people, I really call it 101, right? Before you move on to advanced strategies, you've got to, before you become a biochemist, you've got to take chemistry 101, right? Before you become a doctor, you got to walk before you can run, or you got to do the basics. And so the basics of, don't spend more money than you make. There's a book called The Richest Man in Babylon that talks about that, right? You're just miserable as a person that spends more money than they actually make. And those are valuable things. How do you create a budget? How do you really, do things in the right order so that you're not living out of your means? And it's so easy to live outside your means in our Western culture because of credit, because of other things. So I think it is very important. When you start looking at things that are, really about growing wealth, a lot of people that are very wealthy, they do the very opposite, right? They find a way to take on as much debt as they possibly can. I'm taking on right now as much debt as I can. And it sounds crazy. Why would you take on as much debt as you can? Well, again, there's bad debt, like credit card debt, and there's good debt. If I buy debt, if I feel like I look and I know a market, this is where education and experience and mentors and all books, all this stuff come into play, is when you look at something like, okay, for me in Jacksonville, Florida, I've got a lot of my wealth located in Jacksonville, Florida. And I so believe in the market there and what's happening, where we're headed, that I am putting a lot of wealth in there. I'm taking a lot of debt at, 3 to 5% interest rate, because I see it's very valuable. So in this kind of current environment, again, I'm not giving anybody any specific advice, but this is really what's challenging about the financial markets and investment advisors, is that they can't really tell you what to do with your money, and nobody really cares about your money like you do. And a lot of the stuff, at least in the US, is really, and I imagine in Canada, is very fee based. So it's very much, hey, if you invest with me, if I have all your assets, let's say you're worth, $1 million or $10 million. If I manage all your assets, I get a percentage every year of managing your assets. And I can say this because I was an investment advisor at one point, but I realized that, Wall Street tries to get you into what are called suitable investments, right? Suitable, just get you into stuff that's good enough, that it fits your investment profile. And I just think about, what area of your life do you want anything suitable? Do you want a suitable car, or a suitable spouse, or a suitable vacation, or suitable, you want somebody amazing. You want an amazing vacation. You want a great car. You want things that you're excited about. And so a lot of times there is a misalignment of interest between these financial groups. And so when you look at actually what really wealthy people do, most of them are not just, oh, I've just saved my whole life and I did this and it's been really, unflashy. A lot of them took some risk. They took some calculated risks, and they learned, and they continue to make adjustments. They found unique opportunities, and there are opportunities out there. And as things are changing, particularly with COVID and supply chain and in business and in the world, things are changing so quickly. It creates incredible opportunities for investors to take advantage of some of these changes. Now, there's also opportunities to lose a lot of money. So you don't put 100% of your money in one thing. Maybe you spread it out a little bit, or you learn. I mean, but even the great Warren Buffett, he says you don't need a million investments. You need, maybe 6 investments that you really believe in. You watch them closely, and, put your, because then you can actually keep an eye on them. So there's some of the different things like, major diversification, or just simply buy financial assets just as stocks as bonds. These are safe. A lot of these things I just don't really agree with. I think that they're completely wrong. And I think when you start buying real assets, or you start actually interviewing people that are wealthy, they almost all got there through some what we call alternative strategy. So then it becomes like, well, is it really alternative, or is this just really how people become wealthy? And yet we're all convinced through media and finance that you should be doing traditional stuff. So I find it's kind of counterintuitive to the way we're taught about finances.
Yeah. And I think just looking at, like you said, right, looking outside of the box, seeing what's the options that you have, right? Whether it's in your city, whether it's in your in the backyard, or somewhere else. But like you say, and I do appreciate the fact that, you have these meetups, there's people talking and learning, people that are new, have, never been there, done that. And people who, this is their 10th time around, right? Because it's a world of unknown. But when you prepare, you research, you feel way more confident taking that next step. So
yeah, I agree. No, I think 100%. Everything you said is it's true. There's a lot of strength. If you've never heard of something, or you hear about something the first time somebody hears about, like multifamily syndication or real estate deals that are passive, you just hear about it, it's just some guy on a podcast talking about it. If you go to a local meetup and there's somebody like, oh, I've been doing this for 10 years and I quit my job through this, and they're just telling you their experience. And they're just actually the best people to talk to are people that only passively invest, because they don't have anything to sell you. Like I have some, I have my primary, we do our investments, we have other things that we coaching and whatever. But if you talk to somebody who's all they do is passive investing, they're just going to give you honest feedback, and they have no reason to share anything. Like, they're not promoting it. They're just saying, oh, I worked with this people. It worked really well. I'd never work with these guys again. And those are conversations where it really, to me, started to become like, wow, this actually can work. These are people that are doing it because they just see the value of it, and they've been doing it for years. And this person could become somebody I could stay in touch with and be a mentor to me.
Mm-hmm.
Now, I know there's somebody who's listening to our conversation today who is, wanting to change their financial situation. Maybe they're working 2 or 3 jobs. And one of the things that you learn, if you're someone who, I went through working multiple jobs, you still have multiple things that I'm involved with, but you pay more taxes. Now, there are actually some ways where you're leveraging some of these investment opportunities where you may be able to actually not pay any taxes and do it all legitimately, obviously. But can we explore some of those options?
Yeah, so I'll give some disclaimers. First of all, I'm not a Canadian, so I don't understand the Canadian system, which is a big disclaimer. And sometimes I wish I was Canadian, because Canadians are just so nice, and there's like so much to love about Canada in general. So I have actually a really good friend who's Canadian, so we talk, about Canada a bit. And the second thing is, I'm not a CPA or a tax professional, so I can't give anybody any specific advice, but I'll share my experience. So I was able to save about $150,000 in taxes I would have paid over the last 3 years or more in doing my regular job and then doing real estate investing. And I did it through something in the US, we call it the IRS designation called the real estate professional. So that means the IRS is the tax service here, of course, and they basically have said this designation that if you are basically full-time, or you do over half your working time in real estate, then you qualify as what's called a real estate professional. And I'll get into that in a second, but we really kind of have 2 buckets here, right? You've got this bucket over here, which is for your passive or your investment income through multifamily real estate. And we have Canadians that get involved with this as well, is that they have a US entity, or you're a US citizen, or there's whatever you do, you set it up. And as you invest, you're able to defer or write off taxes through depreciation. So depreciation is basically, you can write off the cost of a house over 27 and a half years. We do the same thing in multifamily, but we can basically do it, bring it all forward to year 1, and basically use all of the depreciation now. So it becomes like $100,000 invested, becomes like a $90,000 on paper or passive loss. So you haven't made any money, you haven't lost any money, you may have made very little money, but you haven't lost any money. So you can take that money, you can use that against in the future any investment income. So what it allows you to do really is to defer the income for 5 years. And hopefully by that time, your 100K has become 200K. That's really the goal. And then now you have 200K, maybe put that in other deals. Now you've got other depreciation that you can use against your income or what you made on that money. So the goal is you perpetually kick the can further and further down the road, and you're able to defer it. So we do that through multifamily syndication. The second kind of magical way is if you can become on this other side here. So we have, your investment income over here. You have on this side is your you're a real estate professional, the IRS decides that you're that, you get all of this depreciation. You actually can use your stuff over here for offsetting against your ordinary income. So meaning, let's say we're doing these deals as a general partner, I get hundreds of thousands of dollars a year or millions of dollars a year of passive losses. I can use that against any ordinary income or other income that I have to reduce that potentially to zero. So I basically was able to reduce it to about a 1% total tax rate. I've seen people do this selling businesses. I've seen people doing it where one is a physician, they're making $500,000 a year. Their spouse is a real estate professional. That's also a way that it works. And they're able to basically pull some of that depreciation over against ordinary income. So just that it's out there, again, I'm not giving any specific advice, but it is incredibly magical. And that's one of the best ways to make more money is just to spend less. So I realized when I was getting ready to quit my job, I could, instead of making 200,000 or more per year, I could be making 140,000 without paying any taxes,
Right.
and it'd be about the same amount. So there's different creative ways you can get it. So that's why I say real estate in some ways is really an unfair asset class in a positive way for investors.
Oh, absolutely. Now, Bronson, we've talked about a number of things financially. Kind of want to take a different approach now and talk about some of the things that you're involved with outside of your day-to-day work. I know there's a couple of things that you're really interested in. One specific mission, if you wouldn't mind sharing with us how you're involved with that, and maybe ways that we can help support that.
Yeah. So I think it's really important with whatever you do to have a big why. Obviously, my daughter, my family, there's a big why that's there. I've just really wanted to be there, be supportive, and have time, be available. This has allowed me to do that. But my big why is, as I'm generating capital, as I'm growing wealth, is I really want to try to end human slavery in the world, which is a big, hairy, audacious goal. There's actually, people don't realize this, that modern day human slavery is actually alive and well. There's actually more human slaves today than there's ever been in the history of the world. It's about 20 to 40 million. I don't exactly know how many, but 20 to 40 million human slaves. Some is sexual human slavery, some is a labor slavery and type of thing for people who moved across borders. And it's very, very common in a lot of parts of the world, even in cities in Canada and the US. It takes place. And so there's all kinds of stuff. I'm involved in an organization called Dressember. It basically creates awareness for human trafficking and raises money. And so if somebody wants to learn about that, they can reach out to me or go to dressember.org. So that's just the word dress, and that's like the word December. So dressember.org, and you can learn more about that.
Thank you very much for sharing that. And so as Bronson said, you can Google him. Just you can search him. Just make sure that you don't click on the former NFL player. You want to make sure you're going after the money guy. Now
we're actually friends on Facebook. I'm actually friends with the other Bronson Hill on Facebook. We haven't met in person, but one day that will happen. So,
well, that's also one of the awesome things about having a unique name. Now, the other thing too, it makes it easy to get websites. So I'll share your website here as well. So it's bronsonequity.com. If you add /report, you'll have access to Bronson's free report that he was talking about earlier. That just really shares investing strategies post-pandemic. Also, you have the Mailbox Money podcast. How else can we find you, Bronson? Or is that anything else that I missed there?
I'm on social media, on all the different platforms on social media. On my website, if somebody's interested in joining or learning about our investments that we do, there's ways to find out about that there. And then we also are doing coaching for people that are interested in raising money, leaving their job, or finding deals. So people can just send me an email. It's just bronson@bronsonequity.com. Love to connect with anybody.
Oh, that's great.
Awesome. Well, Bronson, we appreciate you taking the time to do this again. I have to admit, the first time we interviewed Bronson, I forgot to hit record. We were about this far into the interview. We were about to wrap up, and I realized I had forgot to hit record. So Bronson was gracious enough to make time to join us again. So Bronson, thank you for doing that.
Hey, it's great, man. I feel like we got it even better the second time through. So it was good. So we had a great, we kind of knew we knew where we were going too. So it was good. But no, you guys are great. Love this show, and love being a part of it. So thanks for having me.
Thanks so much, Bronson.
Thanks for coming on. And for everyone who watched or listened, thank you for letting us disrupt your everyday.
Thanks for listening to the Disrupt the Everyday podcast. For more ways to listen, connect with us on social media. To be a guest or to partner with us, check out our link tree at Disrupt the Everyday. Join us next time for more ways to disrupt the everyday.
you.